Welcome to This Explainer. Look, today we're unraveling a massive, and I mean absolutely massive, global mystery. We're talking about how international currencies, the global oil markets, and a literally staggering national debt all secretly connect to dictate your daily cost of living. It's this hidden architecture that quietly governs the entire world economy, and honestly, understanding it will completely change how you look at everything. $39 trillion, $39 trillion. That is the terrifying reality of the United States national debt right now. If we divide that whole shebang up, it breaks down to roughly $114,000 for every single American. You've probably been told that this massive figure is perfectly fine, that it's backed by the full faith and credit of the government. But, well, to understand how this system actually works, we really need to look past those talking points. To really ground this, because our brains just aren't wired to understand a trillion of anything, consider this. If you would spend $1 million every single day since the birth of Christ, you wouldn't even reach $1 trillion. No way. That mind-boggling amount of money isn't even 2% of what America owes today. It is a scale of borrowing that's just, well, it's almost impossible to properly comprehend. So that leads us right to the central mystery of this explainer. With this totally unfathomable amount of debt weighing it down, how has the American economy not completely collapsed? I mean, how does the government just keep printing money without immediately destroying the purchasing power of your paycheck when you go to the grocery store? Well, the answer actually lies in a brilliant, hidden system that you've likely never seen and definitely never voted for. Section 1. The secret engine, the global oil market. To understand this hidden architecture that's basically absorbing American inflation, we have to look at sheer scale. The $2.5 trillion global oil market completely dwarfs the combined value of the world's gold, iron ore, copper, and essentially all other major metals markets combined. It's the single largest traded good in human history. And the magic trick here? For half a century, it has been priced almost exclusively in American currency. 9 times out of 10, when currency changes hands globally, it's the US dollar. And that's driven by this insatiable global need to buy this one single resource. Let's trace this back historically for a second. Back in 1944 at Bretton Woods, the US dollar was actually pegged to physical gold. But by the 1960s, really expensive investments like the space race and the Vietnam War, they completely drained America's gold reserves. So by 1971, President Richard Nixon had to close the gold window entirely, meaning the dollar suddenly wasn't backed by anything physical anymore. Then, when an embargo from OPEC, the world's major oil producers, hit in 1973, it absolutely crippled the vulnerable American economy. But then, in 1974, Henry Kissinger orchestrated a pivotal agreement with Saudi Arabia that, frankly, changed everything. That deal sparked the brilliant cyclical mechanics of what became known as the petrodollar. It acts just like an unavoidable global toll booth. Think about it like this. Step 1. Every single country needs energy. Step 2. Saudi Arabia agreed to sell its oil exclusively in US dollars. Step 3. Countries are therefore forced to buy dollars to get their oil. And step 4, instead of just holding on to those extra dollars, they invest them right back into U.S. Treasury bonds. Essentially, foreign nations' need for energy forces them to finance the Washington federal government. The unwritten rule became very simple. If you want energy, you need dollars. It's that straightforward. In exchange for pricing oil in dollars, the U.S. guaranteed Saudi Arabia's security, essentially giving them the most powerful bodyguard in world history. America took its greatest vulnerability, a paper currency backed by literally nothing, and masterfully turned it into its absolute greatest strategic weapon. Section 2. Bypassing the tollers. But the world doesn't stand still, and this 50-year-old system is definitely starting to show some cracks. Just look at China. They currently import nearly 2 million barrels of oil per day from Saudi Arabia alone. Just to put that into perspective, that is enough to fill 127 Olympic-sized swimming pools with crude oil every 24 hours. For years, China has paid for all of this in US dollars, sending this invisible fee right back into the US system. But with demand this high, countries are highly motivated to find, well, alternative payment routes. And that brings us to something called the Enbridge system. Launched in 2021, this uses central bank digital currencies, which is essentially the official digitized version of a country's money, to let nations trade directly with one another. Why does this actually matter? Because it completely bypasses SWIFT, which is the Western-dominated global messaging system for banks. When Russia invaded Ukraine, the West used SWIFT to freeze $300 billion of Russian assets. Countries like China and India saw that and realized, okay, we need an exit ramp to avoid Western oversight. By late 2025, Enbridge had quietly processed over $55 billion. Economist Zoltan Pozsar famously calls this shift Bretton Woods 3. See, For decades, the world ran on inside money. Those are paper claims on governments, like U.S. Treasury bonds. But as recent events showed us, those can be frozen or confiscated with literally just a keystroke. Because of that huge risk, countries are now pivoting toward outside money. We're talking about physical, seize-proof collateral like gold and other commodities. A new logic is really starting to form globally. Commodities are collateral, and collateral is money.
Section 3. The slow bleed.
So let's take a breath. Are we looking at an overnight, apocalyptic collapse of the US dollar here? No, not at all. The data proves that de-dollarization is a steady erosion rather than some sudden crash. Back in the 1970s, the US dollar accounted for roughly 85% of all foreign exchange reserves globally. Today, well, that share has dropped to 58%. Now, 58% is for sure still a massive heavyweight, but the trajectory is undeniable. This represents the dollar's lowest point in 2 decades.
And there is massive historical precedent for this kind of shift. From the Roman denarius to the Dutch guilder to the British pound sterling, every single global reserve currency in history eventually loses its status. Think of reserve currencies kind of like outdated software. Everyone knows a better option might exist, but switching is super painful, so you just stick with the old one until you absolutely can't anymore. The British pound didn't vanish in a giant explosion, right? It just suffered a slow, decades-long decline in relevance.
Section 4. When the bill arrives. Okay, let's bring all of this high-level macroeconomic theory right to your front door. The U.S. government currently pays over $1 trillion a year just in interest on its debt. $1 trillion. The only reason that number isn't completely suffocating the American economy is because foreign governments are constantly buying U.S. Treasury bonds. That constant foreign demand for our debt keeps borrowing costs, or bond yields, artificially low, which in turn keeps American interest rates, and yes, your mortgage rates, down. To put a very real, very personal price tag on this, $1,300. When interest rates jumped between 2021 and 2023, the monthly payment on a standard $400,000 home loan skyrocketed by almost $1,300. That is the kind of leap that absolutely threatens ordinary family budgets, car payments, and, simple family vacations. Now, I want you to imagine if rates go up not because the Federal Reserve wants them to, but simply because the rest of the world is buying fewer treasuries as they slowly step off that petrodollar system. Which really leaves us with a provocative question. What happens to your cost of living when the world stops absorbing American debt? This entire $39 trillion system only works because the globe is essentially forced to use U.S. dollars to turn on its lights. As alternative roads like Enbridge are built, that dependency weakens. If the world decides they finally have a good enough alternative, that trillion-dollar bill eventually lands squarely on the American consumer. It's a really sobering shift in our global architecture, and definitely something we all need to be watching closely. Thanks for joining me on this explainer.